In this question, we're looking at autumn 2018 question 4, focused on interest rate risk management for 21 marks. So again, roughly about 40 minutes to do this exam, or this question in the exam. Part A was interest rate risk management. Part B was related, it was a narrative on interest rate risk management for deposit, whereas Part A was based on a loan. So you can have interest rate risk either way. And then there was also a relatively under-examined one in SFMA, commodity price risk. And they asked you a narrative question around that. So the first key thing I would highlight is a lot of students should have been savvy and done Part B and Part C first. 8 marks out of 21. Get the narrative marks, the low-hanging fruit, before you start into the detailed calculations. Unfortunately, what some students will do is they'll start in the calculations Part A, get very frustrated, run out of time, and then they won't get the marks in Part B or C because they won't have enough time left behind. So my advice is always look at the easier parts of the question first, do those, clearly label them, and then leave the rest of the time for the calculations. So try and be savvy with your exam technique as well. So I'm assuming you've read through the question. Essentially, this company now has a loan here of 3.95 million, and they currently are exposed to interest rate risk because they're borrowing at a floating interest rate, or what we also call a variable interest rate. So Euribor plus 5.75%. And Euribor currently is 2%. And of course, if you have a loan, you're afraid that interest rates will rise. So they want to manage that. And the bank, Armaz Bank, have given them 3 hedging alternatives. Swap, an interest rate collar, and a fixed rate. And you're asked then in Part A, which we'll tackle first, is for each of the hedges, calculate the interest and hedging cash flows that would arise in year 1 only. And they give you 2 different scenarios. And here they tell you ignore time value of money. So they simplify it slightly. And finally then advise. So first thing always in these interest rate risk questions is ask yourself, what is the company afraid of? In this case it's a loan, so they're afraid that the interest rates will rise. So you're afraid that the scenario where interest rates go up, you're going to lose money. Your second thing is draw out your final table. So in your here you're going to have scenario 1. And you're saying up by 1%. Sorry, LIBOR moves to 1%. So I'll just say there E equals 1%. And scenario 2 then is E equals 3%. And these are going to be our final answers when we calculate them out. And what we're going to say here then is we're going to say no hedge. Now that's not required here, but we're going to do it for tutorial purposes. We say if you don't hedge it at all, what are the possible outcomes? So it's no harm because it's often asked in other ones. Then we're going to say the swap. Then we're going to have the interest rate collar. And finally, we're going to have the fixed rate. And what you're going to do is that's going to be our first page, that nice table, and leave this underneath then for your comment and your conclusion. Much the same like we do company valuations and we do interest or foreign exchange risk. Nice summary table, and you're going to do there working 1, working 2, working 3, working 4. So there's no qualms to the examiner. They can clearly say where the figures are coming from. And that is worth 13 marks. So you have about 2 minutes a mark, about 26 minutes to do something like this. And remember, there's only about 4 or 5 main hedging techniques in interest rate risk. So it's something you should have a cheat sheet prepared with going into the exam. So the first one is then, let's look at working 1. So I'll just come down a small bit. So working 1, unhedged or no hedge. So scenario 1, scenario 2. So the loan rate we know is Euribor plus 5.75%. So that means the loan rate here, if Euribor goes to 1%, is 6.75%. Let's just tidy up that just to make sure we can see it. And if Euribor goes to 3%, it will be 8.75. So in this case, you haven't hedged them. So that means here, tidy up that. You're either going to borrow at 6.75 or 8.75. And that means then the interest for year 1 will be 3950 times 6.75, so 266,000, or times 8.75, which is 345,000. So you can see there that's what the company is afraid of. That is a swing of 79,000, i.e. a 2% swing. So that's not what they want. So that is the outcome. Now you weren't asked for it here, but it's no harm to inform because you might be asked for other ones. that is the unhedged or no hedge position. So big volatility, you could have a cheaper interest rate, but you could have dearer. So that's really not what they want. So nice layout like that. Your second one then is the swap. Now the swap working too, I often tell students the best way to do a swap is to draw it out. So I'm going to show you a diagram that you can download from the website to see, well, how would I draw the swap to get an idea of what happens? Well, let's have a look at the swap here. So we're told in the question, there's a 10-year swap. So remember, with the swap, you will still borrow the money normally, Euribor plus 5.75. So Arma are dealing with this other company X. But Arma are still going to borrow Euribor plus 5.75 and they will enter into the swap. So it's both positions at the same time. So the swap will be Arma will pay 7.3 fixed, which is this left to right arrow. Arma are going to pay out that, and they're paying their bank the normal one. And they're going to receive in Euribor plus 5.7. And there's a fee overall of 0.5%. So the fee overall is paid 0.5%, most likely by each party. We're just interested in Arma. Arma pays 5.75 plus Euribor to its normal bank, and it pays 7.3 to its counterparty, who we'll just call Company X. And in return, Arma gets one payment in receipt, Euribor plus 5.7. But if we take all of these together, this position, we can see the net outcome for Arma of this swap. So they're going to have two outflows, Euribor plus 5.75, that's an outflow, so we leave that as positive, and they're paying the swap 7.3. So some's going to its bank, some's going to Company X, and they're getting in Euribor plus 5.7 from the swap. So you can see what happens to the swap now. These two cancel, and you're left with a net payment of 0.05%. So you pay a net here, Euribor cancels with Euribor, 5.7 cancels the most of 5.75. So the net effective rate you're left with, excluding the fee, is 7.35%. So essentially what happened is Arma have hedged their floating rate loan. So they had a floating rate loan, so as interest rates went up, they pay more interest. But by entering into this swap, they swapped a fixed rate payment for a floating rate payment. They've created an effective float or fixed rate. So no matter where your Euribor goes now, it cancels out and they'll always pay 7.35%. So I think that's the best way to approach interest rate swaps, is to draw them out. Makes it a lot easier to understand where things are coming from. So here, your effective rate, which I'm just going to say C diagram, is 7.35%. Right. And your fee then is 0.5%. So that means overall, your total cost is 7.85%, or in monetary terms, 3.95 million times 7.85%. So overall, 310,000, scenario 1 and scenario 2. So be careful there, it's the same in both, because you've effectively hedged your interest rate risk exposure. So that's an important one. Swap is a common one, but students often get muddled up in trying to look at different scenarios. Just draw it out. Look at the flows to and from the company. Don't forget your fee, and you'll figure out what the net impact is. So go back and practice a couple of other swap questions in that regard. So that's going to be 310,075 in both scenario 1 and scenario 2, because you've locked in a fixed rate using the swap. Okay, so that's 2 of the interest rate alternatives complete. The interest rate collar is working 3. Interest rate collar. So let's have a look at this and see what it is. So this is effectively like an interest rate option. So for the loan, Arma purchases a cap. So what that means is the most your borrowing rate will ever be, it's capped at 7.9%. Now a cap is valuable to a borrower because it sets a limit on how high the interest rate is. So that means you pay to buy a cap. You'll pay a premium. Whereas a floor sets a minimum interest rate. That is costly to a borrower, because that means you can't benefit from lower interest rates. So that means you can sell a floor to a bank because it's valuable to a bank, and you'll get money in. Now just watch out, in more recent years in the syllabus for CAP2 SFMA, caps and floors together are not examined. So this collar is where you're capped at 7.9 and you have a floor of 5.9. So essentially you're collared between these two rates, a high and a low. In the more recent syllabus, a collar is only on for narrative format. The calculations will either be a cap on its own or a floor on its own. But there's not much of a jump when doing them both together. So just make sure you understand them individually. We're examined here together. So let's look then at scenario 1, scenario 2, and the borrowing rate. Now the borrowing rate we've already done from working 1. That's the benefit of doing that initially. We're saying the borrowing rate, so the loan rate, will be 6.75% and 8.75%. So they are the rates if they weren't hedged. And the benefit of the cap and the collar is you may be limited depending on whether it's in or outside the collar. So for example here, scenario 1, the floor is 5.9%. You are above the floor and you are below the cap, so no impact. That's fine. It's within 5.9 and 7.9, so it's just the interest here will be 6.75 times 3950 million. So 266,625. And then we have to do the fees at the end, which we'll come to. But because that's within the collar, there's no issue. Here, this is capped at 7.9%. So that's how a cap would work individually. A cap is valuable for a borrower. A floor is valuable for a depositor, because you want a minimum interest rate if you're putting money on deposit. So that means the interest here is 3950 times 7.9. It's not 8.75 because the cap comes into play. So the interest there, 312050. And then you have the fee for the cap, which you pay, and you have the fee for the floor, which you receive. Okay? So what we see there then is that this is going to be an amount you pay, and you're told the fee for the cap in the question is 2.25%, so a quarter of 1%. So that means you're going to pay 3950 times point, be careful, 0025. 9875, and that's in both instances. So that's important. Whether you use the cap or not, you have to pay it. It's just like an option premium. And that is going to be added on to this because both of these are expenses. You sell a floor because a floor is costly to you. So that means you're going to get 3950 times 0.002 because you're told in the question it's 0.2%. And that will, the reason many borrowers will do a collar is they'll want the cap, but it'll be very dear on its own, so they sell a floor and it nets off the fee. So the total net position there will be 268,600 or 314,000. Now remember, as I said, when you're looking at more recent CAP2 SFMA syllabus documents, the collar is not examinable for computation. What is examinable is the cap on its own or the floor on its own. So if you're a borrower, you might get a cap on its own. If you're a depositor, you might get a floor on its own. The collar really now is only examinable in narrative format for SFMA. So we'll slot those two in, 268 and 314. And the last one then is a fixed rate, a rather simple method if available, where you say you're going to refinance the loan rate at 3950, fixed rate of 8%, and arrangement fee of 0.5%. So effectively for working for your fixed rate, it's going to be the loan rate, which is 8%. Just tidy that up. And the fee, which is 0.5%. So the total rate there is 8.5%. And if you convert it to money by multiplying by the loan amount, you get 335,750. So that's a relatively straightforward option again. So remember, when you're looking through them, similar to what I said about A, B, and C, do the easy ones first. Swap is probably the hardest one. Do your collar, do your fixed rate, do your unhedged if it's there. Get them done first. So always be strategic in your sequencing. Don't tackle the hardest one if you're not confident. Because what can happen is you can get frustrated, you can go short on time, and then you'll end up rushing the easier narrative or the easier calculation pieces. So a big part of CAP2 is, because it's such a long exam, is exam technique. So that brings us back then, 335,750, and because you've fixed it, it doesn't matter which scenario, both are the same. So it's going to be there and it's going to be there. So you have a nice neat table now of your answers. And what you're asked then in part A as well is to advise which hedging approach to use. So if you have a look through them here now, we'll figure out which one would you make a recommendation on. You should really just approach this in terms of ruling ones out. Right? So say for example here, the swap and the fixed rate both guarantee outcomes. So clearly the swap is more preferable than the fixed rate, because the fixed rate is 25 grand higher in both instances. So you can kind of discount that straight away. So then it's a toss up between the swap, the collar, or unhedged. Now unhedged is quite volatile and it's not actually an option here. We just did it for tutorial purposes. So you're really tossing up between these. And if you look at it, for possibly 4 grand extra in scenario 2, you could save an awful lot of money in scenario 1. So really, on the balance of outcomes, the best value for money here looks to be the interest rate collar. It certainly isn't the fixed rate, because that's dominated in both scenarios by the swap. Then you're tossing up a guaranteed 310 for a high at 314 or a low at 268. And the benefit here for the collar outweighs a lot of the small increase that you might have in scenario 2. So again, it's all about coming to a rational conclusion. You're probably talking about 2 marks there for your conclusion and 11 marks then for calculations. But quite popular. And remember, risk management is guaranteed on the paper the way the syllabus is written in 2019-2020 at least. So then what we're looking at is your next part, which is part B. Advise Ardman on alternatives to a bank deposit for the 2875 and recommend a suitable short-term investment option. So what they're saying here is they're going to get 2875 and they want to see where they're going to put it. But they're concerned about very low returns. So this is like interest rate risk, only the other way. So it's a bit of like treasury management coming in here as well from Strategic Finance Session 6. So some of the alternatives, you can have a look at the solution, but watch the recommendation. So you can recommend leave it on deposit is the current option. You could say put it into government bonds because it is for 2 years. You could say put it into corporate bonds. So corporate bonds generally have a higher rate of return, but they do take on a bit more risk. And you could also say put it into the stock market through an equity portfolio. Now, the general point would be for 2 years is a very short investment horizon. You're probably not suited to put it into an equity portfolio because the share price could go up or well as down in the next 2 years, and you may not have enough money on hand for the future acquisition in 2 years' time. So the most realistic one, as you'll see in the solution, is probably put it into a diversified portfolio of government and or corporate bonds. Less risk involved, and what you're looking for is the lower risk bonds, because 2 years is a relatively short time frame to make sure you don't have a big peaks and troughs or volatility in that value. Right, so 4 marks, don't spend too long on it, give 3 alternatives and make a recommendation. Finally then for another 4 marks, and I said both B and C really should be done at the outset to get your easy low-hanging narrative marks. Explain the commodity price risk. So we've talked about foreign exchange risk in finance session 7 and interest rate risk in session 8. But there's also another market risk, commodity prices, whether it's oil, gold, silver, or in this case zinc and ore, lead ore. Because you're told they have zinc and lead mines, it sells them on the daily commodities price market. So of course the big risk for them is they've made huge capital investments, so they have a high level of fixed costs because they have to finance them, but they're selling their stock or they're selling their inventory into the commodity price markets. So that means they can have a very volatile price each day. They don't know what their prices are going to be. So your revenues could fall dramatically, but you'll still have a high level of fixed costs. So that's the big commodity price risk here, is the volatility in their income, because they don't know what they're going to sell the zinc and the lead ore at every day. That's all I have to say. Two possible approaches to managing this. While the likes of Ryanair, they hedge their fuel using futures or forward contracts, you could enter into a forward contract to sell your zinc and lead at a fixed price now for some time in the future. So you can enter into long-term fixed price agreements with your customers. You could enter into future price contracts. Remember, future contracts, they are traded on the exchange. So they're standardized. And you can also enter into use options. So you might want to use, for example, put options here, the option to sell zinc or lead ore at a certain price in the future. So you don't have to do any calculations. Explain why there is commodity price risk, because the uncertainty of their income, depending on where the price for zinc or lead ore is, and also explain the use of futures, forwards, long-term fixed price contracts, or even options. They're all available for commodity prices as well. The likes of zinc and lead ore, or the more common ones, the likes of oil futures. You could have gold futures, silver futures, etc. So that was just bringing in another area of market risk management, because it's typically SFMA is dominated by interest rate and FX, but commodity price risk is another important one for businesses. So that was looking at interest rate risk management in general at Autumn 18, question 4 for 21 marks. And the key takeaway is, firstly, think about your sequencing. Do the narrative first if you can, and then think about the structure and the layout of your calculations. A lot of the interest rate and foreign exchange risk calculations are set out like a table like that, using 2, sometimes 4 scenarios, and nice cross-reference your workings to make it easier for the examiner to follow. And then leave a bit of the page to make your narrative comments at the end. And you can read through all the detailed narrative suggested solutions in the CAI solution.